Iran sits on the fourth largest proven oil reserves, more than 200 billion barrels locked beneath shifting sands in the Zagros Mountains, yet the average Iranian earns less than 1/4 of a Saudi and endures blackouts during summer heat waves. Tehran pumps just over 3 million barrels of crude daily, but nearly half leaves the country aboard shadow tankers, sold at steep discounts, mostly to independent refineries in China operating in legal grey zones. In 1974, Iran rivaled Saudi Arabia at 6 million barrels per day. Today, it barely scrapes past half that mark. So what went wrong? How did the original cradle of Middle Eastern oil lose its grip on greatness? And who is really profiting from Iran's petroleum empire in the shadows? Today, we crack open one of the strangest paradoxes in global energy. Look at the world map and Iran leaps out, a land where snow-capped peaks crash into scorching deserts, where the mighty Karen River winds past date groves, emptying into the Persian Gulf. Those first 100 kilometers of Khuzestan are soaked in crude so rich, locals joke you can smell gasoline in the soil. Persian engineers struck oil at Mashhad-e-Solomon in 1908, a discovery that lit the world's first Middle East oil boom long before anyone found crude in Saudi Arabia. Iran's geography is a geological jackpot, limestone folded into perfect hydrocarbon traps by the same tectonic collisions that built Zagros. Behind those ridges, seismologists estimate 208 billion barrels of recoverable crude, fourth largest on the planet. In theory, every Iranian child owns a slice worth millions of dollars. American engineers later installed rigs that pushed production to 6 million barrels a day in the 1970s, rivaling Saudi Arabia's output. Tehran's streets flashed neon, women showcased Paris fashions, and economists spoke of joining the world's top 10 economies. But scroll through satellite images at night, and Tehran's glow looks dim beside Riyadh's neon halo. Something doesn't add up. How did the birthplace of Middle Eastern oil end up lagging behind its younger siblings? To answer that, we need to rewind 45 years to one of the most dramatic political upheavals of the 20th century. The winter of 1979 crackled with slogans and bonfires. When millions of Iranians toppled the Shah, oil workers joined the strikes, shutting valves from Avaz to Keshem. Overnight, production collapsed from 6 million barrels a day to little more than a trickle. International majors, BP, Exxon, Shell, fled with their blueprints and spare parts. Tehran announced a bold plan. The new Islamic Republic would run everything itself, free from colonial plunder, but ideology couldn't replace drill bits, and output never recovered its pre-revolution glory. Then Saddam Hussein smelled weakness. In September 1980, Iraqi jets bombed the Abadan refinery, igniting rivers of crude oil that burned so hot residents said the night turned crimson. The 8-year Iran-Iraq war swallowed a generation and more than $500 billion. Karg Island, Iran's main export terminal, was hit 200 times. Tankers threaded the so-called Missile Alley under constant threat. By 1988, the world's fourth biggest oil power was importing gasoline to keep taxis running in Tehran. Yet, amid the carnage, Iran proved stubbornly resilient. Engineers cannibalized spare parts, welded pipelines at night, and devised floating hoses when jetties lay in ruins. Production crept back above 3 million barrels a day by the early 1990s, but the miracle hid a deeper wound. Investment had stopped. Wells drilled in the 1960s were aging fast, reservoir pressure was falling, and enhanced recovery technology was a foreign luxury. The war ended, but the peace was fragile. Global investors remained wary of a nation whose coastline still bristled with unexplored ordnance. Iran's leaders were about to discover that bombs can be defused, but reputational scars linger far longer. As a tentative post-war rebound began, a new, quieter weapon was already being forged in Washington. Sanctions that would cage Iran's oil ambitions without firing a single shot. By the mid-1990s, Iran's oil sector stood at the gates of revival until it slammed into American legislation known as ILSA, threatening hefty penalties on any foreign firm investing more than $20 million in Iranian energy. European giants hesitated, Chinese state firms bargained hard, and vital technology for horizontal drilling never arrived. After 2006, nuclear suspicions triggered United Nations resolutions. By 2012, Iran was locked out of the global banking system, and SWIFT cut transactions to Tehran overnight. Numbers tell the pain. Crude output fell from 4.2 million barrels per day in 2011 to 2.5 million in 2013. While exports plunged 60% and the rial lost 2/3 of its value, inflation soared above 40%. At gasoline pumps, subsidies kept prices bizarrely low. So smuggling tankers crisscrossed the Gulf to sell cheap fuel abroad, draining billions from state revenue. Meanwhile, aging fields lost about 8% of pressure each year because enhanced recovery chemicals were sanctioned out of reach. Hope briefly bloomed in 2015 when the JCPOA nuclear deal eased restrictions. Within 18 months, production rebounded past 3.8 million barrels per day, and Total of France inked a $20 billion agreement to develop South Pars. Tehran cafes buzzed with talk of Porsche dealerships and tech startups. Then Washington changed course. In 2018, the United States withdrew from the accord and revived maximum pressure, blacklisting tankers, insurers, and port operators worldwide. Yet sanctions work like a leaky dam. By 2025, satellite trackers show Iran still managing to export up to 1.8 million barrels per day, most destined for China's teapot refineries, using ship-to-ship transfers and ghost tankers that vanish from radar by switching off transponders in international waters. The crude flows, but at discounts of $10 to $15 a barrel and through a clandestine maze that inflates transaction costs. Crucially, in March 2021, Tehran and Beijing signed a 25-year comprehensive strategic cooperation agreement. In exchange for a steady stream of discounted oil, China pledged tens of billions in investments spanning railways, ports, petrochemicals, and 5G networks, essential lifelines that help Tehran skirt financial isolation. For Beijing, the bargain isn't just about cheap barrels. It deepens Belt and Road logistics, secures energy for the world's largest importer, and bolsters a political partner that can pressure US interests in the Gulf. So sanctions haven't stopped Iran's oil, they've simply made the boom impossible. Walk into a Tehran taxi, and the driver may joke that gasoline is cheaper than bottled water. For years, that was true. The state spent up to $40 billion annually keeping fuel prices artificially low, a populist policy meant to share the oil wealth, but the bargain had a hidden cost: staggering domestic consumption. Iranians burn roughly 2 million barrels of crude and condensate every day, almost as much as they export. Subsidies encouraged gas-guzzling Pekian sedans and kept insufficient power plants humming through the night, siphoning funds away from new drilling. The cheap fuel regime also birthed an underworld. Along dusty roads to Pakistan and through creeks along the Gulf, smugglers siphon subsidized diesel into hidden tanks and then sell it abroad for 5 times the price. Authorities seize about 10,000 smuggling vehicles each year, yet the racket persists, bleeding billions. Every barrel lost this way is a barrel that could have fueled investment in modern refineries or injected precious port gas into aging fields like Gasharan and Maran. Inside those fields, the clock is ticking. Most Iranian reservoirs are more than 50 years old and suffer natural decline rates of 7 to 10% annually. Injecting gas or water could halve that slide. But compressors, turbines, and smart well tools often carry American patents. Public anger flares each time subsidies are trimmed. In 2019, a surprise fuel price hike sparked nationwide protests that shut down highways and left hundreds dead. Leaders face a cruel equation: keep prices low and starve the industry, or raise them and risk unrest. That stalemate stalls any genuine boom. But Iran isn't isolated in this battle. Global market forces are closing in as well. You see, oil demand is no longer a one-way escalator. Electric cars cross Tehran's highways every month now, and Asian giants pledge carbon neutrality by mid-century. Yet, for the moment, China's teapot refineries keep Iran afloat. In March 2025, those independents imported a record 1.8 million barrels per day of Iranian crude, about 13% of China's total intake, often rebranded as Malaysian or Omani grades to dodge sanctions premiums. Traders call it blurred barrels, and each shipment sells at a $10 discount to Brent, cash that never reaches full potential. Beijing's strategic calculus goes deeper. Buying from Iran diversifies supply away from the Strait of Malacca choke point, locks in energy for its vast industrial base, and strengthens a partner willing to accept yuan payments, reducing reliance on the US-dominated dollar system. Beyond pricing, OPEC politics complicate any expansion. Iran once fought tooth and nail for higher quotas, but years of underproduction left it sidelined, while Saudi Arabia and the UAE installed state-of-the-art capacity. Even if sanctions vanish tomorrow, analysts say Iran would need at least 7 years and $150 billion in foreign capital to lift output sustainably above 5 million barrels a day. That window is shrinking as investors pivot towards renewables and short-cycle shale plays. Logistics add another choke point. The Strait of Hormuz funnels a fifth of the world's oil through a channel only 39 kilometers wide. Any threat, real or perceived, spikes insurance rates and pushes buyers toward more stable suppliers. Tehran has floated bypass pipelines through Iraq, Oman, and even Syria, but these remain mostly on paper, stalled by financing hurdles and geopolitical risks, with foreign banks unwilling to foot the bill. Meanwhile, Russia's cut-price Urals blend competes directly with Iranian grades in Asian markets, further squeezing margins. Imagine Iran free of sanctions for a moment. Foreign engineers fly into Avaz with cloud-based seismic tablets, drill ships anchor in the Caspian, and billions in capital flood the national Iranian oil company. Productions climb past 5 million barrels a day, natural decline is arrested by gas injection schemes, and petrochemical parks in Bushehr turn out high-value plastics. The economy doubles within a decade. It's possible, but only if 3 stubborn locks are opened. First is diplomacy. The new sanctions rolled out in April 2025 target not only oil sales, but also the tankers themselves, signaling Washington's intent to strangle any shadow trade. Tehran and world powers would need a verifiable nuclear understanding that survives changing administrations, plan ironclad guarantees for investors against snapback penalties. Second is governance. Even insiders admit corruption and opaque budgeting bleed billions. Greater transparency, auction-based contract awards, and independent reserve audits could rebuild trust faster than any speech. Iraq's post-2008 licensing rounds show how quickly capacity can rise when terms are clear. Third is diversification. Oil alone cannot lift 85 million citizens forever in a world racing towards renewables. Iran holds the world's second largest natural gas reserves and 2 sun-drenched deserts perfect for solar megaprojects. Combining gas-fired power with solar and wind could free more crude for export and slash domestic smog, a win that pays twice. These reforms are heavy lifts, yet history proves Iran's people possess uncommon resilience. They rebuilt Abadan after bombs and bootstrapped refineries from scrap metal. Do you think Iran's oil story is one of resilience or missed opportunity? Drop your take in the comments. Smash that like button if you learned something, and subscribe for more global deep dives.